Get on with the conversations on the Money Show, though. And in fact, let me introduce my guest without further ado. We've got Chintan Haria, who is the Head Products Strategy at ICICI Prudential AMC. Thanks so much, Chintan, for joining in. And we're talking about a product that is on the anvil for ICICI Pru. This is the ICICI Pru Strategic Metal and Energy Equity Fund of Funds. What is this product about? Obviously, it's a fund of fund, but it is focusing on assets abroad, on companies abroad. Could you give us a little bit of information as to how this works?
Thank you for having me on your show. See, when we were looking at creation of products across our various platforms, there's something which Indian investors generally don't get access to and is missing as part of their overall allocation right now, but is very important from Indian context. We are the largest, or our largest imports are oil and gold, and we do not have representative oil companies and gold companies which are global in nature listed in India. So with that thought process in mind, wherein whenever prices of oil and gold do go up, currency also depreciates, we thought why not bring a product to the investors which can help them participate in global oil companies and global gold mining companies as part of a single product. And when this plays out in terms of oil and gold probably doing well and currency depreciating at that point of time, it will be to the benefit of Indian investors. And that's where the ICICI Prudential Strategic Metal and Energy Equity Fund of Fund is positioned for investors to invest in the underlying fund, which is based in Europe, to which in turn invests in oil and gold companies, which are the largest in the world. And the Indian investor can get the benefit out of those oil exploration companies and gold mining companies doing better. That's the whole objective of the fund.
Okay. Chintan, we'll get into some more details as to the strategy and where this should fit into somebody's portfolio. But I'm just trying to understand how the underlying fund, what is the criteria that it uses to select the assets that it acquires? This Europe-based fund, how does it select the companies that it invests in?
Sure. So there are two indices essentially, which are the underlying indices or benchmark indices, the S&P Oil Exploration Index and the New York Stock Exchange, that is the NYSE Gold Mining Index, Gold Miners Index. Those two have the largest oil exploration companies and the gold mining companies. So the objective over here is not to do bottom-up stock selection as such, but to have a representative approach wherein the largest of oil exploration companies and the largest of gold mining companies in a particular proportion, and that is important. The range is 30% to 70% between oil and gold that will be there in the fund, and that's basically based on the largest companies getting representation there. So it's less about bottom-up stock picking, more about getting the exposure to the world's largest oil exploration companies and gold mining companies.
Okay. I want to understand the strategy involved here. One of the, or rather, as I understand it, and correct me if I'm wrong, Chintan, the thesis that you're following is that as an Indian investor looking to diversify their portfolio, you need to look at assets abroad, therefore, right? You need to look at funds that invest in international assets. And quite a few of these offerings have an orientation towards tech, and that's where this particular fund comes in because of the kind of focus that it has on commodities. But isn't commodities highly cyclical? What do you have to bear in mind? And talking about crude, we're talking about a lot of expectations that maybe in the next decade you could see much reduced use of crude overall in the energy space.
Sure. So I think you covered a lot of facets of this particular product. The first facet is essentially if we look at valuations across the board of international equities, especially the US growth and US technology-led equities, they are trading at probably twice the multiples that they used to trade in 2006-07. They've got re-rated. The performance in the last 10 years has been very good. If you compare that with oil and gold mining companies, they've got de-rated. Their valuations are cheap relative to the tech companies. And like you said, they do not form part of an investor's portfolio today because people believe that in the next 10, 15 years, the requirement for oil may not exist, courtesy the electric revolution or the solar revolution that we are seeing. while that may be true that oil demand may come down after 10, 15 years, what we believe is that for the next 3, 4, 5 years at least, oil demand is not going to go down, or it may not go down as much as it is anticipated. And along with oil, you have gold as well in this portfolio. And there's a mix of 30 to 70%, which we'll probably speak about in a bit, that allows investors to participate if there is an oil boom, and there is a possibility. You saw no one would have expected oil to touch $90 in Brent, but it did so a few days back. Because while the demand is steady, the supply is coming off because in the last few years, the investments in oil haven't been that strong. So while we do appreciate that in the next 10, 15, 20 years, the world may be different, but in the next 4, 5 years, this is still a story which probably has legs. And that's where investors can potentially benefit out of it, especially on a relative basis where probably Indian equity valuations are not the cheapest. Debt, because of rising interest rate scenario, may not be an asset class where you want to put all your money in. And also inflation running high. It is a good hedge against inflation generally, and gold and oil both provide you with that hedge when inflation is running high. So apart from the fact that what you mentioned, US tech, where I think more than 30,000 crores of Indian investors through the mutual fund route are exposed to global investments, this becomes a good addition for diversification of the existing assets, because today both oil and gold equities globally do not find a representation in the portfolios of Indian investors. And we being largest importers, or our large imports being oil and gold, this becomes a good hedge for the Indian investments and a diversification into a cheap asset class.
Okay. And you were pointing out in terms of the portfolio statistics, you mentioned in the product note that currently about 31% of the holding is in gold stocks and 69% in oil stocks. And you have the biggest of the big, you have the likes of Chevron, you have ConocoPhillips as the biggest holdings in this fund. But I'm just trying to understand in terms of where it sits in the overall portfolio, as it's meant, as you're pitching this product. I see the riskometer and I see that it has a very high risk rating. So how does an individual investor understand where this fits in their portfolio?
Sure. So if you see the riskometer and the very high risk rating is because underlying is equities, that would be true for the equity investments which the investor would have. That would be true for the international equity investments which the investor may have. So while the riskometer is saying what it is saying, it essentially from a fitment perspective, today an Indian investor's typical portfolio will have Indian equities, which are not necessarily the cheapest that they were. Future may be good, but there is a need for probably diversifying from there, especially the growth-oriented equities, both in India and in US. The US tech for 12 years, 13 years has done very well, and valuation-wise, like I said, it has become a bit expensive. And as far as debt markets are concerned, given that inflation is running high and expectation of global as well as Indian interest rates going up, you do not necessarily want to put everything in debt. So you can probably look at it as a fitment wherein between debt and equity, there is a space for oil and gold today. And that's where the oil and gold equities, if you take out some money from the US tech, take out some money from the Indian equities, take out some money from the debt, and allocate it to this portfolio, this will act as a hedge against probably rising inflation. And also if oil and gold do well, you do not have the representation in any of your existing investments in a major way into global oil equities and global gold equities. And since, like you mentioned, the allocation to both these, that is oil and gold stocks, is done in a manner wherein if the momentum is in favor of oil as a commodity, oil will get overweighted. And hence, if you see in the last few months, since oil has been doing well, oil is 70% of the portfolio roughly, and gold is about 30% of the portfolio. When gold starts to do well, gold can become 70% of the portfolio and oil can be 30% of the portfolio. So the idea is that one investment to provide these two asset classes, which probably is not there available in the market that easily. And Indian investors do not have an exposure to that as well, and they are cheap. That's where the fitment lies as far as the strategic allocation is concerned. With a 3-year view, we believe this will add to the diversification, lower the risk, and probably help wealth creation of the investors over the next 3 years.
Absolutely. Thank you so much, Chintan, for joining in and for taking us through the clip notes of the product that you are launching. Pleasure speaking with you as always.
Thank you, Alex.
All right. On that note, we're slipping into a short break, but we're going to speak about one of the commodities that we were just speaking about, which is gold, in a lot more detail. We're going to be joined by the World Gold Council representative in just a short while. So do stay tuned.